All right, guys, welcome to Reflexivity in Markets. I'm Steven, this is Jordan. Um, Today we were going to talk a bit about what's happening in the market, especially uh, more about Bitcoin and the ideas behind um, the oncoming banking crisis or the current banking crisis, as you can define it, some real estate, and a bunch of other things. So, um, right now, Bitcoin's trading at 28, just past 28. It tapped to 29 last night. Uh, and and so throughout social media you'll see signs of uh, you know people making the case for why Bitcoin matters or why transparency in finance matters. So we'll talk more about that today. uh, our first topic, we kind of talked a bit about real estate before this call. uh, Jordan, what are your thoughts on the commercial real estate section as they
Uh,
are now?
so basically, we're talking, systemic level risks or macroeconomic risks and how they're unfolding. Uh, One of the biggest things being tweeted about in the world of crypto, Twitter, finance, which is always full of fascinating pseudo truths, is a lot of panic and fear around commercial real estate finance, which is a multi-trillion-dollar market, and over the next year, kind of the debates about how many hundreds of billions and or potentially around a trillion need to be refinanced at potentially higher rates or likely higher rates than most of them have been used to for 15 plus years. Um, at the same time, the demand for commercial real estate by renters and lessors, in the case of offices, for example, and retail is really plummeted as people have shifted to the kind of post-COVID era of work from home more and a lot more of a gig economy where things are a lot more transient and temporary, hyper localized, and the central office spaces just aren't very useful. So kind of there's a lot of, let's say, almost panic selling or distress in that space. And places like New York are have like record lows in occupancy. But while I understand the fear around this, and there's two main arguments I'd bring up against this, and this is one is the redevelopment that Stephen and I were talking about before we started this. Is these are all assets that can be redeveloped in key markets where people want to live. That doesn't mean every place will. Bubbles and shifts in the structure of the economy are localized. So there may be a case that we don't need office space in places that people didn't want to live in before anyways, but places like New York where there's a lot of social drive to live in that scene uh, now may have an increase in the amount of available multifamily residential real estate after we slowly convert it.
How long does that usually take to get the zoning and get the right documentation in place to make that transition? Because I feel like it's not just, you know, you, it's not just you decide to buy a commercial real estate and within a few months you're able to do that. So what, based on
Yes.
your experience, what have you found? The
So
basic time is not to be exact, but like an average timeline of what people
I
are looking
think
at here.
it's realistically important to understand this kind of hasn't happened before. The best thing we could say is, and first, before we jump down that, the other truth of why I'm less skeptical about the real estate collapse is commercial real estate is not a category where we've never seen quantitative easing interventions before. We're following a playbook by the Bank of Japan that was written in the 90s, and we've been following it pretty well for the last 15 years in the United States. We've we've seen asset bailouts in what's called qualitative easing, which is the spreading of the Federal Reserve's balance sheet and other entities' balance sheets across multiple categories of assets, not just quantities of assets. And some of those assets will include commercial real estate, investment trusts, or C REITs, and the debt that goes behind them, which is part of how Japan ends up with so much debt being backed by the government and so much centralization, which is just the bailout of successively larger and larger and more diversified categories of assets that you have to support when an economy is essentially collapsing on the weight of its own bubble. And instead of making hard decisions that might take take a real hit to some assets in the short term. You take really small decisions that cumulatively erode your position long term, which is kind of one of the long term arguments for BTC. But if we're talking about redevelopment, it's more about you'd have to use a sample template as the redevelopment of some of the industrial cities into these, let's say, hipster zones.
Hmm.
So you'd look at, places like portions of Brooklyn that had a lot of industrial conversions, places in downtown LA where they turn them into lofts. It is a multi-year process.
Yeah,
What
most
we
major
have,
cities, right? Like Toronto has it. Like I'm from Canada, so most major cities have that just that section where the industrial section is now, yeah, the hipster section, or the loft style breweries and small businesses that are able uh, to make use of the space. But yeah, you're starting to see more real estate, like in terms of like leases for residential purposes. Makes sense in those areas because they are usually in pretty decent areas of the cities. Like they're closer to the transit, they're closer to like major shopping centers, or um, there's parts that does make it a little bit easier for people to move around. Just from my experience in those areas.
but it is like, we've seen this as a matter of preference for where to live when these weren't so abundant and the urgency of it wasn't so clear. We've seen this take, right, decades usually, right? It's a let's say on the short end, it's 7 to 10 years. On the long end, some of these are 15-year transitions. There might be more urgency now because there's a shortage of housing, and housing affordability is a major crisis throughout the entire country and in many countries. And suddenly there's a surplus of these assets. But we haven't seen laws put forth or proposals put forth to solve the financial or the regulatory constraints around this. So we need basically special development zones or special economic zones. A bunch of countries have different names for this, but places where you take some of the rules off so that you can accelerate a process that's politically or populist driven, including accelerated rezoning, accelerated approval for environmental impact, changing some of the health standards and health codes around it because some of these buildings have different materials they were built with at a different time. And then kind of the key constraint that everybody's focused on right now, which is land and commercial real estate have this, and commercial real estate may be slightly more efficient to redevelop than land is to initially develop, have this very high capital burden that is extremely expensive in the current interest rate environment to finance because people are still financing at SOFR or the old LIBOR or rate plus somewhere between half on the really low end and realistically more like 2%. Uh, and that's a pretty expensive proposition relative to current rent rates, even. So there's not a lot of people willing to take that financing risk, though that could change quite quickly if the Fed continues to have to pivot and other banks also continue to have to pivot. If we
So,
saw
so you're thinking that that's in the cards, and most longer term real estate driven investors are starting to shift their focus towards commercial real estate. Is that kind of like your thesis is starting to change towards
my
that?
thesis would be that they are shifting their kind of opportunistic mindset to where's the first cities or states to start offering incentives, to start offering tax credits, to start offering leniency on redevelopment of these assets because default on these assets is both not tolerable systemically, but it's also not tolerable on a local level.
And we haven't
Vacancy,
seen any yet. Yet we haven't seen any
right?
any tax credits or any incentives from municipalities or states for that.
Right. We just haven't, at least we haven't seen them at a large enough scale. They're not on my radar. And so let's say for the purposes of considering New York, for example, we're hearing conversations about it, but we're not hearing, not seeing clear proposals. New York will be a kind of key market for this. They have some of the highest concentration of ultra valuable real estate in a city that is, it's indecipherable why somebody would not want to live in a former banking tower when they live in a tower that's 2 blocks down the road that from the outside looks just the same. Um, It's not the same as saying, "Oh, let's move a bunch of people who are used to living in houses in Toronto or Los Angeles into a bunch of towers." It's there's it's a fairly seamless transition by preference. It's just not economically or from a regulatory perspective. But currently, we still have a barrier to financing, and it would take a hell of a tax credit to offset the current cost of financing and the cost of building materials. So that's why I say I would expect to see a shift to redeveloping commercial real estate before I see a shift towards kind of redeveloping land or developing new land, because at least you have some of the bones in place,
Right.
some preliminary plumbing, commercial scale structure, which is very expensive to build on, and in many cases, for example, like law offices, have insanely high weight load tolerances on their buildings. Because they have large libraries. So switching that to a residential situation where someone now has more stuff per person is probably quite tolerable, and some of this stuff can be reinforced. So yeah, I'd say commercial real estate is a place to keep your eye on as a potential place for opportunities to get real estate exposure in redevelopment. But like most of these things, you should expect it to go to the most connected players with the largest amount of influence
Yeah.
who are getting these assets.
All right.
So,
Let's yeah, let's shift to. I'll just share this here. Oops. So yesterday we got some news about uh, China and Brazil deciding to deal and trade in their own currencies. And I'm just gonna pull up the tweet here. So you should be able to see that there. But so China and Brazil have reached deal to trade in their own currencies, ditching the U.S. dollar. And Jordan and I talk a lot about the U.S. dollar, as a reserve currency, what that means for markets, what that means for investors, how they should, you know, how we can start looking at that as what's important going forward. So yeah, when I saw this, again, it just compounded the fact the past 3 weeks, I guess, have just been really, really difficult time for the U.S. banking sector, um, and this kind of just is adding to that fire. So, yeah, what are your thoughts on this China Brazil uh, news that came out?
So this follows on the heels of first multi-year speculation that Saudi Arabia would switch out and still hasn't totally switched out for its settlement um, of oil payments. They've just speculated on a bunch of different versions of settling this, but it does follow also on the announcement that Russia and China would be settling in yuan probably, and transitioning completely away from dependency on the dollar, which is creating a new trading block in the East. This is not a U.S. dollar dependent trading block, and it's not really in anybody's interest in that region to continue U.S. dollar dependency. The only major player left to make a choice about how this will work is India, and India probably doesn't want to settle in the yuan because they have their own ambitions. But the U.S. dollar's importance is being materially eroded quite quickly.
Didn't we hear? Was it like a month ago, or maybe towards the end of last year, that um, India was had an agreement with Russia that they would trade with the rupee for oil. That
I
was
might have missed that one,
Yeah.
but,
I'll look for the link on that. But yeah, go
but
ahead.
it's not going to be a yuan block. So what we're seeing is kind of
No.
a thesis that goes along with what's being called ally shoring or onshoring or regionalization, where the globalization move, where everything was backed by the U.S. system, is losing its strength. And for a lot of people, that's the thesis that they're saying, has been claimed repeatedly, is a Bitcoin bull thesis, that everybody will switch to the new form of digital gold. Um, I'm not sure that's one that I entirely believe in, but I do see how that is a popular narrative. It's just we're not really seeing that play out. What we're seeing is dollar disintermediation, but not a switch to something like Bitcoin or Ethereum as the new way of settling it. Which would be, I mean, you'd think this would be the moment, right? If we're going to see it happen, uh, this is kind of an important testing moment, and maybe that's just we haven't seen a big enough shock to any of those currencies settlements for them to want something else. But for the moment, it's not quite playing out the fairy tale that a lot of people have in this space.
Now we talk a lot about that too with Bitcoin as a form of payment. It's not quite there in terms of just the rails it has, the scalability, the ability to transact and for the users themselves. In this case, it'd be nations or international markets. Like how do they um, how do they maintain control of those lines of communication between countries or companies that they're trading with? Uh, like that's always a question. And Bitcoin, because of its transparency, it may not be the best way for countries to go about that. But uh, yeah, it just comes into question again why why the U.S. dollar is where it is today, and as you see today, the Dixie's down another 0.5% and continuing to fall. Um, yeah, it's just interesting to look at.
Yeah, it without global trust in this, which is also about global dependency, there's a lot less demand for dollar reserves and even short term dollar holdings to make immediate payments on debts. We still have significant dollar denomination, which means that trade and contracts and a lot of legacy economic interactions are dependent on U.S. dollar. But when announcements like Russia or Brazil come out that make it clear that the BRICS are moving away from dollar settlement, what comes next is if it's not really the medium of exchange, it's not going to be the unit of account, and that's what denomination is. So the three
Right.
functions of money. Let's just kind of run through that because that in this space we have a kind of often a disparity in this. Is you have to be or ideally, money is measured by whether or not it fulfills the three goals of or functions of being a store of value, being a medium of exchange, and being a unit of account. And unit of accounts are defined by the contracts that we actually use to measure economic activity. And when these announcements come out about settlement for trade, it's kind of both medium of exchange and unit of account. Because when you change the medium of exchange and then you announce long-term settlement will be done in a new exchange mechanism, what you're actually discussing is restructuring future or forward-looking contracts to to no longer need dollar units. The step after that would be debt no longer needing to be dollar denominated for people to feel safe in it. So that's kind of the one we haven't seen a lot of yet,
Yeah.
but it's coming. I there's not a lot of reason to believe that it's not coming at this point. We have no functional control over the US dollar's performance. We have really failed in every category to provide its first level of utility, which is being a stable medium of exchange. And one of the plays, not to get too political on this, was a very aggressive move to believe that we still had enough pricing power in the market, or enough political power in the market to cut Russia out of the system uh, and use the SWIFT mechanism as a weaponized tool. And it turns out they don't need it. Um,
Turns out they don't care.
yeah, they don't care. They don't need it, and no one cares.
Yeah.
Um, we could play that game when we were the largest counterparty in trade, when we were everyone's military stabilizer. We've lost both those roles. China is now the largest trade partner for almost every country in the world, and on a military basis, we aren't perceived as necessary because of an sustained period of peace throughout the world, and our interventions have gotten extremely costly and divisive. So and I say that as an hour being the U.S. Although fortunately, Canada is actually the only other person besides other country besides Mexico that's in the boat with us. So we all seem to still think that the United States is relevant, but that's kind of the regionalization thesis, right? This is
That's right.
ally shoring and regional focus instead of globalization.
Yeah.
So in that, yeah,
So
that's kind of
what does the what's the play for the U.S. at this point? Uh, Especially with everything that is happening right now. Obviously, they don't the recent most of the recent actions the past few weeks has been a way to just kind of put a band-aid on what's happening. But this has been like a systemic issue for that's been happening for a long time and it's been growing. Um, what are some options or what can be done to try and regain that U.S. dollar um, supremacy as a medium of exchange, or at least what alternatives do they have uh, to kind of stay relevant within that framework? And if there's not a if it's not a solution, what are we looking at in the next 5 to 10 years as possible outlooks for international trade, international settlement?
yeah. So it kind of has a caveat. A lot of times in this context, we're going to have to simplify or shorten arguments around this. So there
Yeah,
will be gaps in this, but uh, dollar supremacy or reserve currency status for a nation is always a fairly binary situation. You either are or you aren't. And so you're kind of always playing for all the cards and all the chips at the same time. It's in Ukraine. It's we win this 100%. We destroy the ability to resist dollar supremacy. We cut off an entity that defies it, and we hope that that play works out. And once you're in that play, kind of unwinding it, there's no strength in undoing this. But it may just be necessary to accept that we've lost that role. Um, the argument could be made that many of the nations that are trying to displace the U.S. dollar with their own forms of exchange are going to experience exogenous shock events, um, basically Southeast Asia level shocks from the late 1990s or Russia level shocks from the 90s, uh, or a 2008 level crisis, and that could reset things to looking for something that is potentially more stable. But the biggest problem is that the United States has taken a position that's largely dysfunctional across most of its policy that prefers to have kind of its hand on too many scales at once without remembering that our primary role was military and financial. We didn't we could use those at times to affect the trajectory of other nations, but we've gotten too involved in too many other goals that we try to assert through these kind of blunt tools. And we're very useful and valuable as a country when we facilitate peaceful trade throughout the world and free exchange largely through our financial systems. And the more we try to isolate key trading partners in the world out of that system, the more we realize we don't have our leverage is kind of proportionate to how free the system is, which is also to say that it's always been limited. We're just eroding its significance now. You can only push somebody so far with your economic incentive before they find another system. So when they do that, your leverage becomes immediately lower if they can sustain that for any material amount of time. Let's say 5 to 10 years, and build the new rails. And we're seeing that already. We just
yeah,
don't. In that sense, we move too slowly. Our financial system continues to evolve too slowly. We did put in significant very significant support systems for key crisis moments like dollar swap lines internationally to allow other banks to have access to dollar liquidity during essential moments because markets continue to get faster. But even all of that is actually now too slow. It is, we're in a social media viral era where every bank run, and it's kind of a topic we'll kind of ease into here, is every bank run, every financial vulnerability is moving at a speed that is unprecedented, and we have refused to update the system uh, to to settle fast enough and to be 24/7, 365. And without doing that, we're just behind the times.
that's
And
right. Like during 2008, how many people had mobile banking on their phones? Were had just had the technological or the technological like literacy to even consider making payments or withdrawals or transfers from their phone. Now it's literally, if you don't do that, uh, you're behind in the times, or uh, something's missing, right? So it's a huge change in the speed at which things are happening, and as you were saying before, the social media attention that these crises take on is just like extrapolating that to uh, the nth degree. And we were talking about how this affects the U.S. dollar and the banking system, and it just seems like things are starting to break. And then, you know, nothing is ever as bad or as good as it looks, but there definitely needs to be changes. Um, I'm not sure how fast they'll be implemented, or if there will be just be uh, international, um, I guess, other opportunities that you can look at for those that have access to them. But within the U.S. banking system, I don't see. I have a hard time seeing without conflict of how they can solve the issues that they're currently facing.
Yeah, I mean, some solutions would be to stop fighting crypto. And I don't. By the way, we're gonna have to break this apart. It's like, stop fighting blockchain tech.
Yeah,
Yes, fight the fact that 99% of crypto concepts are Ponzi pump and dumps and don't last long enough to ever have their quote flywheels realize their quote use cases. Um, and and that doesn't mean that at the same time instant settlement via 24/7 365 operating chains that have, let's say, sub 15-second finality, or in some cases sub-second finality, uh, isn't a useful technology that can help clean out and clarify the positions of financial intermediaries during moments of crisis, or moments of accelerated bank runs. So we have right now too many parallel systems that are designed to allow for instant transfers but aren't part of the primary banking system, or allow for consumers to move a certain amount of money, which in small amounts is fine, and we can calculate kind of a certain amount of liquidity that's available to facilitate these parallel transfers without needing the central banking reserve balance sheet accessible 24/7. But we're way past the point where we can operate in those parameters. The numbers are just too large. They're approaching tens or hundreds of billions of dollars that can be moved, or at least are perceived to be able to be moved almost instantly
yeah,
by consumers on their phones.
yeah.
And that's a new era, and we're still talking about a system that wants wires to be settled. Oh, try to do it the next day. We'll try to do a same day wire. Okay, well, if we can withdraw money in 30 seconds, we can't be waiting 6 hours to process a wire.
No,
Um,
especially at a time where there's so much credit in the system, and there's so much credit just based on how economy grows. Now with this increased speed of transactions, if those the counterparties uh, to these creditors, if they don't have the backing, or if they don't have the ability to keep up with those transactions, or at least have a record of what's happening and react fast enough, well, you can see what happens, right? You can see bank runs, you can see insolvencies, you can see massive transfers of wealth really fast. Um, and yeah, it's just really interesting to see the speed at which things are happening. And luckily, like for you and myself, like we've been in this crypto space for a while now, so it's easier for us to adapt and make those changes. Uh, but you're starting to see it in an institutional level, and even on an investor level, like where do people park their funds? Like where is a safe place to go where they know that they can have access to it in the case they need to move it quickly, because if people that are holding, or the institutions that are holding their debt, or institutions that are uh, that they're working with, they're not able to go at the same speed. um, they're going to look for alternatives. They're going to look for competitors that will offer that that service, and they'll be out there, just maybe not in the U.S. We'll see.
which is a pretty material loss of both technological and financial significance in the world, if
Yeah,
if that's the route it goes. And this is not to say it's a done deal, but it is. important to remember that other countries, even in the last 40 years, have been the country of the future, quote unquote. Like that's like a kind of a concept of what it is. So Japan was the country of the future. It was kind of poised to overtake the United States in the early 90s. Uh, when you are in that position and you have a major shock moment, you can either kind of reinforce those ties and become that centralized player, or is in Japan's case, fail to become a reserve currency for other nations, and kind of realize that there's too many structural problems with your economy to maintain the growth rate, maintain the dominance in other markets. One of the problems being that a lot of Japanese capital would flow to the United States and other markets to buy real estate. You kind of need that to be the reverse. If you're going to become the reserve currency status, you need cash flows pretty much just flying capital straight into your economy constantly. Um, and that transition becomes kind of self-fulfilling eventually. But you do need to survive those key moments, and Japan did not. And it'd be worth noting that United States could fall into a similar position where we just simply lose the same demand for like the way of American life and the assets and participation that takes, and with that, a loss of interest in financing our, you can, to not be political about it, just flagrantly reckless spending that doesn't matter which side or how you calculate it. It's just way in excess of anything we have any plan to ever repay or honor the debts of or control. It's just way outside the bounds.
Yeah.
Um, so we're kind of losing credibility at the same moment as we also lose desirability. Uh, and so when we talk about the speed of these transactions internationally, and the speed of the systems we've designed, there's a lot to that's kind of not discussed on a daily basis that includes what languages communicate at what speeds, right? A market might transmit data when it's open nearly instantaneously and process all the inputs from its participants. When it's not open, it's not processing this information. When settlements are or assets are recorded in one form, they can be, for example, holding long-term debt with the deposits you hold from your bank. Uh, it's one thing to say, okay, they're marked to market when markets are open, and it's another thing to say they're held to maturity, meaning that they don't actually have to be marked to market. They may face some alternative regulatory definition of what their value is, which is to say that there's an, in crypto terms, another oracle that is replacing the live feed from the market with some alternative, let's call it in crypto terms, hard coded exchange rate. Um, and the problem is, if bank deposits and other liabilities of a bank are in fact instantly accessible and instantly claimable, bank runs have always existed because of this problem, and the assets you hold are not. Uh, you need moments to kind of clear out the system when no one can do anything, and those were weekends before and banking holidays, and they just don't exist anymore.
Yeah.
And, and they're not as functional, and demands are very clear and fast. And in that world, we're losing track of the fact that accounting is kind of the super slow language of value and of transfer. And in accounting, we have standardized laws around what things should be valued and how they should be valued and accounted for. And when they are very slow, like Basel III agreements and gap accounting, we end up with banks that actually don't hold enough assets to back the positions that they owe their clients. And when that's happening at the speed, there's a lot of demand for an alternative at system at scale. And you can hate blockchain all you want, but it is faster, it is cleaner, it is simpler, it is more direct. Whether or not it's a CBDC or anything else you want, it's still a necessary speed we have to move at, and you can achieve it a bunch of different ways.
Yeah.
So, so yeah, that's kind of our dollar erosion and settlements chat, and I kind of would touch on maybe a little bit of some of the other topics we have in store for today.
Yeah.
Um,
So with the patches that we had from, I call them patches because that's just the way I see them, but like with the short term, um, the short term, yeah, the patches that were put on the regional banks that suffered uh, some losses the past couple of weeks. Uh, we saw the banking sector, um, specifically with Silvergate and uh, Silvergate. And what's the other one? It's been so long now that I can't even remember.
Silicon Valley Bank
Silicon Valley Bank.
and First
Uh,
Republic and a bunch of others.
yeah, there's a few of them. Uh, we're starting to see a way that the U.S. Banking sector can try and maintain trust and control, but I just think it's not really a strong case that they're making. It's kind of just like a short-term patch um, that people say is technically it's not quantitative easing, but we talked earlier. I don't know how it can't not lead to quantitative easing. It's just I'm not sure what their end goal is with it. When you have loans that need to be paid back from these banks um, that may not have the deposits ready for those repayments. Uh, yeah, it's just a lot of unanswered questions when these loans come up, when they're due, or how that's going to translate to people actually, uh, trusting the banks and trusting the banking sector, and what the ideas of quantitative easing, uh, what what that can that can do to markets and people's just general trust in the banking sector.
Yeah,
Yeah,
no, I think that it's when we talk about quantitative easing, it's kind of been a story of that's been the Cinderella story behind why Bitcoin's great or why some alternative that can't be so easily manipulated by a central entity would be desirable. And setting aside some of the specifics of that case, it's hard to see how this short-term stopgap actually addresses any of the problems. Because what we did was, as a system, we made it a matter of policy for 15 years to hold interest rates at zero. There's no precedent for ever coming out of that hole in any durable sense. When you build an economy, when you sustain rates that low for that long, you build economic structures on top of it, including businesses, policy statements, uh, you know, government budgets that are built off of not needing to actually pay for things. Uh, and oh, that's an interesting group. Just let me silence the invites to this thing that I just got. Um, Cool. I think we've just solved that. So we built an entire economy on this idea. We, and the longer it lasts, the more layers you build on top, the more swaps you build on top, the more permanent relationships or decade long relationships you build on top. The more people do things that sound completely insane, like, hey, let's issue a 56-year bond, or Microsoft and Apple now have debt that's maturing in the 2050s, and they have for a while. There was at one point an entity that issued a 100-year bond. I can't remember who it was, but these right. It's indecipherable. The idea of this is purely it's almost insane to tell somebody in the 1990s, oh, don't worry, we're going to issue a 50 or 70-year debt instrument. Um, if you were to look at the history of modern history of humanity, there's no period during which we have maintained peace long enough to justify promising those terms and having someone price them at near 0%. Um, and so you start building companies that are profitable with margins that are 6 or 8% and levered. Great, that's a really solid business. But when interest rates start climbing, all of those businesses which have now equity multiples, right? You're profitable, so you get some multiple applied to you and evaluation, and then you can borrow more debt against it and fuel this in this bubble cycle. You raise interest rates even a little bit, the business isn't even profitable. The leverage on it is totally unsustainable. And now you actually have a bunch of debt that is a fixed denomination that is essentially unsustainable and needs to be, let's say, gone through a resolution process or a deleverage.
repackaged.
Yeah, repackaged and delevered. Or in the case of Japan, you accept eventually repackaging will be monetization of the debt and ownership of those assets by a select few banks that are backstopped by the BOJ and by the BOJ itself, with Bank of Japan. Right, Japan. Um, so so it's a very fragile system built off of really garbage quality assets. Um, and a lot of entities that really can't sustain their business models or their leverage or profitability or their valuations, which they've built debt on in any heightened interest rate environment. So in the face of that, we tried to raise interest rates to fight inflation, which is its own questionable topic. But let's say it was necessary to try to choke off demand. Um, it turns out we finally hit a threshold where people didn't want to keep their cash in these banks that were offering them almost no return, and that in conjunction with the fact that the banks had speculated in the order of trillions in purchasing long dated assets and holding them quote to maturity against deposits that were on demand available now left a pretty big hole in the balance sheet.
Yeah,
So we've got a bunch of stopgaps coming in that say, okay, well now you can borrow against those assets at at par effectively, which means you're 80 cents on the dollar asset. You can borrow up to 100 cents on the dollar against it. You pay a slight interest rate premium relative to even what that asset is yielding. So you are earning a negative interest rate spread, but your business can continue to exist.
yeah,
And so it's an interest rate trap in that sense because you've set yourself up to say eventually we do need interest rates to fall or we need all these banks to be sold off to banks that actually can sustain this business, and the only reason those banks can sustain this business is because we trust them. The reason we trust them is because we know that JP Morgan will get a line of a bailout and an emergency line of credit. um, and we went well past that. The treasury acknowledged they may have some taxpayer liability now for some of the costs of resolving SVB. And so yeah, that's kind of where we're at, is this impossible trap to get out of, and a quote temporary quantitative easing that the only terminal effect outcome for has to be either banking consolidation and then quantitative easing and monetization of debt, or direct quantitative easing steps where we go in and say, all right, we're going to keep buying this debt, and don't worry, it's going to it's not just a short-term loan. We'll actually take it off your balance sheet.
yeah.
um,
It blows my mind. I don't understand how at such a large scale this is something that's possible. Just don't worry, just trust us, and everything's going to be okay. Uh, but yeah, like you already see like the past few weeks, I think it was like $200 billion were withdrawn from banks themselves, and then um, there's probably even a larger number that have just been transferred to the major five or six banks within the U.S. Uh, and it comes to a point where okay, you have all these assets in a handful of banks. You have promises that the debt is secure, everything is fine, everything is going to be fine until it's not, right? So, uh, as alternatives, like what are people's options? Obviously, for you and myself, we're in the, we kind of believe that this quantitative easing is going to take effect eventually in the near term. It's going to get ramped up pretty fast, depending on what's happening uh, within international markets as well as domestic. But there has to be like, something has to give. Something has to give, and my bet is that the U.S. Banking sector is going to take a hit, and the government has to be there to bail them out if they want to stay somewhat relevant within the international sphere. So it's like this weird, complex intertwining of the U.S. dollar losing its global supremacy while at the same time losing its own domestic trust. Um,
I mean, there
they only
are.
have so many tools, right? Like, they only have so many tools as a government to keep things afloat because you know that's why I was when we first talked to it started this episode. Um, there's conflict or there's these tools, right? And the U.S. has one of the biggest militaries and the most you know the biggest global presence, but at some point, like that's going to dwindle down as well. So we're going to see some. In my perspective, we're going to see some action fairly soon, either through the government's uh, idea of quantitative easing or a way for the U.S. to regain some type of trust globally and domestically. Um, Something has to give, right?
Yeah, I mean, that is the trade off, which is like, do you save yourselves? Do you save? There was a time when things were talked about in the context of first world and third world, or kind of the inner primary circle of nations that can borrow in their own currencies, and those who can't, those who have direct ties to U.S. banking, and those who have to go through intermediaries, and a lot of that doesn't really matter. It was a lot easier to pitch when the alternative was Russia and a system that didn't have the complex financial rails to endorse capitalist flows and cross border flows of capital. When there are competing alternatives that are largely capitalist, even though they're wrapped in a Chinese Communist Party blanket or whatever you
Yeah,
want to call it,
yeah,
there are alternatives. And when we're in this situation that we're in right now, the debate is kind of very similar to Japan's decision. Do you try to maintain your international supremacy that you're emerging as, or do you accept that the first layer of power for any political entity is domestic control? Because if the people who put you in power to run your country don't elect you again,
yeah,
uh, you don't really have an international stance. You're just not even in the conversation. So the default stance is going to be save the U.S. banking system for U.S. participants first,
yeah,
and that will be highly inflationary to asset prices. It will devalue the political power and the financial bargaining power and utility of dollar reserves, both domestically and abroad, because we will effectively promise all the large banks that have to absorb all the small banks, and eventually probably promise a bunch of small banks the same level of access. And when you do that, what you do is you remove, every time you do this at every level and every step over the last several decades, you remove risk, or you remove the perception of risk from the system, and you encourage longer and longer term gambles and business models that are built off of a full government backstop.
mhm,
And that is a fragile system to keep pushing. And it is what we are headed towards. And we will choose to save the US for the US and lose our position probably
yeah,
globally in that sense. So what systems are emerging is is what everybody in this space is probably should be focused on, even the ones who believe they are. And obviously, Dogecoin is the future of currency. I should say that was a joke for everybody. But it's in these moments where we're editing the back end value of ledgers essentially, and saying what your recorded assets aren't your recorded assets because we just changed the price of them in the back room. Where people really question, is this a technology, or is this an approach to solving things that leads to any trust? Um, and I'm not talking about trustlessness versus permission. It's just, is there any trust or belief that this is a sustainable system?
yeah,
Um, and if it's not, what can we use as an alternative? So, we'll keep an eye on that. And in the meantime, we're going to continue to see mid-tier banks and even large banks like Credit Suisse experience extreme stress, temporary liquidity measures to rescue them, and then eventually consolidation, like in the case of Credit Suisse or SVB Commercial being sold off uh, to entities that can sustain that risk. And this is the approach that's been taken for 150 years or 135 years, something like that. Is you find somebody bigger to absorb your smaller, unsustainable position. And as long as that entity continues to fulfill some key network role, like payments or storage of value, because someone needs to keep the money somewhere,
mhm,
it's viable. But if people get tired and fed up with that, they may want something like Bitcoin or some alternative store of value or ability to pay each other, and that's
yeah,
kind of a topic that everybody in this space is obsessed with.
yeah. Seems inevitable.
Yeah.
Yeah, I
When
guess
will we
I'll.
all go to blockchain?
Yeah, I mean that's why we're here, right? We're trying to find solutions to these problems on every scale, right? And on large scale, on through micropayments or like whatever you can think of. Just makes sense. Like every time something like this happens, around the world. It's just like it just keeps adding to this thesis and keeps adding to the fire. Um, for all of the devs in the space and the builders, it keeps them motivated and keeps them working towards it, even though there is questions about who will be, which country will support them, um, where they're going to find that home where they can develop these technologies. And obviously, as we said, 99% of all these are trash Ponzi's, but the technology is what we're focused on. And there's some cool stuff happening. There's some cool stuff um, that people do have alternatives to look into. So yeah, any other topics you want to chat about before we end today?
Just so I think on our kind of our next chat, we'll probably be talking a little bit more about if this is our thesis, kind of what the two of us are doing around that, or what we would be looking at as possibilities, including, are we getting considering more exposure to something like Bitcoin or to Ethereum, even just purely for the narrative? Or are we considering um, exposure to entities that are closely tied to CBDC development, like Quant? Um, or kind of how to play this, a very variety of ways that we might be playing this, or somebody might want to consider, and some of the risks that we should all be aware of. Obviously, none of this is financial advice; it's for educational purposes and entertainment. But some thought provoking conversations to come about what's the role of these kinds of potentially speculative or alternative instruments for people like us and how we see them. So
Awesome.
looking forward to that on future episodes of Reflexivity and Markets. I'm Jordan. This is Stephen, and it's a pleasure having you here. Don't forget to like and subscribe.
Take care, guys.